Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else. Welcome to another video on your channel Profit and Equities. In this video, we'll be talking about Motilal Oswal's 5 stock ideas post the second quarter corporate earnings for the fiscal year FY 2019-20. Now friends, if you like the content that we produce on our channel, please don't forget to like this video, share these videos, and if you have not already subscribed to our channel, please click on the red subscribe button and choose all notifications to be informed whenever we upload a new video. Also friends, we run a couple of very successful Telegram groups and channels where we have successfully outperformed the markets. While in the investing group, we are up more than 33%. On the trading group, we have almost doubled our money. If you want to go ahead and join our Telegram groups, please go ahead and open a completely free Demat or trading account through the link provided in the pinned comment or in the description of the video. You can also choose to become a YouTube channel member by clicking on the join button and then following the steps. For people who cannot either become a YouTube channel member or open an account on Upstocks, the third way is to become a patron on Patreon. The link for all of these are provided in the description of the video. Please watch this video to know more about these stocks. Now the company in question is Colgate Palmolive India Limited, which is available at Rs 1504.50 and the face value for it is 1. The symbol for it is COLPAL. Now Colgate Palmolive India Limited is engaged in the personal care and oral care business. The company offers various personal care products such as soaps, cosmetics and toilet preparations. The company's oral care category of products includes toothpaste, toothbrushes, tooth powder, whitening products and mouthwash. Now Motilal Oswal has said that Colgate appears undervalued given its own healthy medium-term earnings prospects and also on a relative basis compared to its peers. In terms of guidance, Colgate will prioritize volume-led sales growth even if it comes at the cost of near-term EBITDA margins. Now looking at the one-year chart, this company has performed well relative to the market. The market cap of the company is 40,920.24 crores, which means that this company is a large cap one. The EPS of 29.52 translates into a price to earnings ratio of 50.97, which is slightly cheaper when compared with the industry price to earnings ratio of 62.41. The price to book ratio of 28.29, however, is very expensive. The company is debt free and hence the debt to equity is 0, whereas the return on equity for this company is also a very strong number at 0.5102. The dividend yield here is 1.53%, which is also a decent number, whereas the promoter holding is just about average at 51%, out of which nothing is pledged. Now the second company on the list is Ashok Leyland Limited, which is available at Rs 81.35 and the face value for it is 1. The symbol for it is ASHOKLEY. Now Ashok Leyland Limited is a holding company engaged in commercial vehicles and related components. Through its subsidiaries, it is engaged in manufacturing and trading in medium and heavy commercial vehicles, light commercial vehicles, passenger vehicles, automotive aggregates, vehicle financing and engineering design services. Now Motilal Oswal has said that they prefer PVs over CVs and two-wheelers as it is likely to be the least impacted segment from BS6. The other reason for their preference is that it has also got a stable competitive environment. Ashok Leyland system inventory has also reduced to 13.2 thousand units in October 19 versus 18.2 thousand units in September 19 and close to 27.5 thousand units in June 2019. The company also maintained its cost savings target of close to INR 5 billion in FY20, of which INR 2 to 2.3 billion was already achieved in H1 of FY20. Now looking at the one-year chart, this company has not really created any major wealth for its shareholders and has generally been a laggard. The company is a large cap with a market capitalization of 23,880.51 crores. The EPS of 4.78 translates into a price to earnings ratio of 17.02, which is slightly cheaper when compared with the industry price to earnings ratio of 21.46. The price to book ratio of 2.43 is also not wildly expensive. The company has a very high debt to equity of 2.9661. However, the dividend yield is very attractive at 3.81%. The promoter holding stands at 45.36%, out of which 9.26% is pledged. Now the third company on the list is Jubilant Foodworks Limited, which is available at Rs 1562.70 and the face value for it is 10. The symbol for it is JUBLFOOD. Now Jubilant Foodworks Limited is a food services company that operates through the food and beverages segment. The company and its subsidiaries have the rights to develop and operate Domino's Pizza brand in India, Sri Lanka, Bangladesh and Nepal. It also has a right for developing and operating Dunkin' Donuts restaurants for India. Now, Jubilant Foodworks is a significant beneficiary of the corporate tax cut compared to peers, thereby increasing its competitive advantage and freeing up over 45 to 50 crore rupees every year. High base of same-store sales growth is now largely behind, while the urban demand scenario seems to be not worsening anymore. Valuations at 40 times FY21 earnings were well below the 5-year and 10-year average of over 60 times, leading Motilal Oswal to upgrade Jubilant Foodworks to a buy. Now, looking at the 1-year chart, this company was consolidating for the majority of the year, but of late it has had a huge spike. The market cap of the company is 20,622.80 crores, which means that this company is a borderline stock between a mid cap and a large cap. The EPS of 24.03 translates into a price to earnings ratio of 65.03, which is slightly more expensive when compared with the industry price to earnings ratio of 58.07. The price to book ratio of 16.34 is also on the higher side. The company has a debt to equity of 1.3623, which is not really good, whereas the dividend yield stands at 0.32%. The promoter holding stands at 41.94%, out of which 2.54% is pledged. Now, the fourth stock on the list is JK Cement Limited, which is available at Rs 1162.80 and the face value for it is 10. The symbol for it is JKCEMENT. Now, JK Cement Limited is an India-based holding company engaged in manufacturing cement and cement products. Its product portfolio includes grey cement, white cement and wall putty. Now, Motilal Oswal has said that they remain structurally positive on the Indian cement sector due to expectations of limited new capacity addition, which should result in improving utilization, assuming a normalized demand CAGR of 5 to 6%. JK Cement is also expected to deliver volume growth from its new capacities. Now, looking at the 1-year chart, this company has been on a beautiful uptrend and has resulted in a lot of wealth creation. The market cap of the company is 8,984.75 crores, which means that this company is a mid-cap one. The EPS of 61.28 translates into a price to earnings ratio of 18.98, which is considerably cheaper when compared with the industry price to earnings ratio of 36.47. The price to book ratio of 3.33, however, is slightly expensive. The company has a debt to equity of 1.0605, whereas the dividend yield stands at 0.86%. Now, the promoter holding for this company is a strong number and stands at 58.07%, out of which nothing is pledged. Now, the final stock on the list is Aditya Birla Fashion and Retail Limited, which is available at Rs 219.45 and the face value for it is 10. The symbol for it is ABFRL. Now, Aditya Birla Fashion and Retail Limited, formerly Pantaloon Fashions and Retail Limited, is a fashion and lifestyle company. The company is engaged in providing branded fashion apparels and accessories along with the retail sale of clothing, footwear and leather articles in stores. It operates through two segments, which are Madura Fashion and Lifestyle and also Pantaloons. Now, revenues for this company's retail universe grew 16% year on year in the second quarter of FY20. This company saw strong 14% revenue growth along with healthy same-store sales growth. ABFRL saw a 29% slump in PAT attributed to higher ad spends and higher store ads leading to lower EBITDA margins. ABFRL targets to open 400 lifestyle brand stores in FY20. This company is aiming for mid-teens revenue growth for lifestyle brands and Pantaloons. Margin improvement of 200 to 300 basis points in Pantaloons is what is being targeted. Now, looking at the 1-year chart, this company started this year with a small uptrend. However, of late it seems to be forming somewhat of a rounding bottom formation. However, the confirmation is some time away. The market cap of the company is 16,977.25 crores, which means that this company is a mid-cap one. The EPS of 3.90 translates into a price to earnings ratio of 56.27, which is slightly cheaper when compared with the industry price to earnings ratio of 62.33. The price to book ratio of 11.88, however, is expensive. Now, one alarming aspect about this company is the very high debt to equity, which stands at 3.1611. The return on equity is 0.2359, which is decent. However, the company does not pay out any dividends. Promoter holding is also a decent number at 59.09%, out of which nothing is pledged. Now, friends, having watched this video, please be aware that this is not a research on our part. We'll be providing a link to the source for this video in the description section. Please go through it to build more conviction around your investment decision. Also, friends, if you like the content that we produce on our channel, please don't forget to like this video, share these videos, and if you have not already subscribed to our channel, please click on the red subscribe button to be intimated whenever we upload a new video. Thanks for watching and you have a great day ahead.